All right, everyone. So I guess we're going to start. We usually wait for 10 minutes for more people to come, but apparently some people were scared by the coronavirus, I guess. Hopefully, yeah, they won't, like the coronavirus will not be a factor next time. So as usual, we'll be starting with the February headlines, and the topic of today. I'll be talking about all these three DeFi protocols, and actually they'll be in different order. First I'll be talking about Maker, then I'll be talking about Compound, and then about Synthetix. First with the headlines though, and this is Ivan.
Hey everyone. As always, we release a poll where you, ladies and gentlemen, vote on what was important this month. So the value locked in DeFi protocols exceeded 1 billion in the month of February. I think it peaked at like 125, which was partially new influx, partially the ETH rallying. Tezos price action, and Jelly supporting Eternity, which seems like a shameless plug, also made the cut. So let's start with 1 billion in DeFi. So yeah, as I said, assets held by DeFi smart contracts exceeded 1 billion. More than half of that was in the MakerDAO smart contract ecosystem, which is like more than 250 smart contracts. And the main use case currently existing there is the minting of the DAI stablecoin, which is pegged to the dollar. I found pretty cool the fact that Uniswap has a 4.5 times more volume than Bancor, which shows that you do not need a shitcoin to have a good product, and you also don't need that much funding. And the only non-Ethereum based DeFi tool, so to say, where there was some value held was Lightning Network on BTC with about 8 million. Something that surprised me that didn't make the news was the hacks that happened over the last few days with a protocol called BZX. So it was a total of 1 million stolen over 2 attacks, which is actually still, I mean, compared to the billion locked in, that's tiny. Both attacks relied on the flash loans, which is a concept where you borrow without posting collateral, and you repay the loan within the same block. And it's used by arbitrageurs that equalize prices across different DeFi protocols, or they exploit vulnerabilities. I think that was pretty cool. I mean, okay, some people might have lost money, but in the grander scheme of things, it's what doesn't kill you make you stronger type of story, and I think it's a net positive for the industry. Also, because it's relatively high profile, like a lot of people got interested in it, and so a lot more attempts at an attack would happen, meaning vulnerabilities would be exposed while there is relatively little value at risk, right? Like there is only 1 billion in there, and the more attempts there are, the better the system becomes. Tezos price action, I honestly, it's not a topic. Price action is not a topic where I know anything about, so I'll try to talk a bit about what Tezos is. So it's one of the many Ethereum competing smart contract platforms. Ironically, they're focused on governance, and I'm saying ironically because they basically postponed their launch with a few quarters because there was a massive dispute between the foundation and like the board that was disbursing the funds that they raised in 2017 to the foundation, and they had massive problems there. Finally, they launched like a year and a half after raising the money. Currently, it's one of the top assets. It's one of those that actually have working proof of stake, even though it hasn't been attacked. So we know it's working now, but it hasn't been battle tested, so to say. Yeah, and they're aiming to become the platform enabling smart securities, tokenized securities, and real assets on chain. Price increased fivefold since October, and as always, a ton of narratives of why that was happening emerged after the fact. Jelly Swap supports Eternity, as in like the Eternity token. So what is Jelly Swap? It's a cross-chain atomic swap dApp. It was built by Wadex, which is part of the Eternity Venture Starfleet. They are supporting 3 chains at the moment: Eternity, Ethereum, and the ERC20s that are Ethereum-enabled tokens, and BTC. Actually, I was hoping some of the guys from them will be here, because like a curious question is why atomic swaps are not more prevalent, considering that it's like the core technology is part of the BTC stack, which has been around for quite a while. So maybe you can answer.
It's not that easy to develop.
Wait.
Oops. So I think it's not that easy for people to understand and develop, so that's why it's not that widespread. But I think it's a good protocol, and also it enables decentralization at the top level. So a lot of people are also interested in just making quick cash and don't care much about decentralization, and I think that is also one of the things that is like holding it from mass adoption. Like, that's my opinion.
Was that all actually? All right, so, and here is the price of BTC, which was looking much better 2 days ago, and now we are a little bit here. Possibly might go down a little bit more in the next couple of days. And Ether is still up than like when it was in January, in comparison to January. And yeah, so now we're going to jump into the main topic of today, which is the 3 top DeFi projects. And I would ask Ivan to support me with some info if he knows more, or if he can like further elaborate on the different concepts that I'll be talking about. So as I said, Maker, Synthetix, and Compound. By the way, going back to the first point, DeFi, the value stored in DeFi is now under $1 billion after today. So it's about 900 million. And one other point there, actually this information about like 1 billion stored in DeFi is coming from DeFi Post, the website. And most of the information there is actually, you shouldn't be taking it as a clear coin, because I think some of the amounts mentioned there for the different projects are actually double counted, because some of the projects are actually interconnected. So one, like they're looking at, for example, Maker, and then they're looking at Compound, and Compound also has DAI inside, so they're double counting the DAI. So the actual amount is not 1 billion, but as my friend Pascal mentioned during the DeFi meetup last week on Wednesday, it's good for marketing. That's already past 1 billion, amazing. But so okay, let's jump into this. So I will be looking at like this little screen here. So we are going to start a little bit further away from Bitcoin to DeFi, from the fact that actually Bitcoin is the first DeFi project. If you look at it generally, like in the broadest possible sense, Bitcoin is really the emanation of decentralized finance, because it creates money, provides money sovereignty and liberty to the people. And its main purpose is like financial independence through intermediation, which means that yeah, we should remove those pesky bankers and all the intermediaries which exist in the financial system, and we would open the financial system to everyone. We will make it permissionless, so everyone can like acquire Bitcoin, use Bitcoin, transfer Bitcoin without anyone like being able to stop them to do that. So there are a number of advantages, of course, to Bitcoin. So there's, of course, you know most of these. I mean, you know most probably all of this. So there is no single institution. Anyone can join. It's transparent, it's divisible, self-regulating, deflationary, counterfeitable, which means this is actually very, very cool. No, but many people are not focusing on this advantage. Unlike gold, for example, where you need a third party to verify if what you have in your hand is gold. In Bitcoin, you can have a full node, and that full node verifies that for you. So you don't have to rely on a third party to be sure that the asset that you have is actually worth something. And fast international payments, clearing, and settlement. You know all this. Actually, the Bank of America Merrill Lynch considers Bitcoin to be the best asset of the decade. I'm not completely sure that this news is correct, but this guy is from CNBC and he reported it, so I'm not sure if they really, because yeah, it's on the news. So I tried to find the original source from like Bank of America Merrill Lynch, but I couldn't do it. I couldn't find it, but it's all over the news. And when you look at it, if you have invested $1 in 2010, now you have $90,000. So it kind of looks like, I mean, quite good returns from Bitcoin. And there are, of course, disadvantages. The price is super volatile. It's more of a digital gold, which is not really a disadvantage. I mean, it's just a store of value. Not that much used for payments so far. Pseudonymity. So that means that each transaction is kind of it's transparent. I mean, it's related to transparency, and you can follow a transaction moving from address to address to address. So there are companies actually doing this professionally. And I think the American government, there was news yesterday that the American government is using chain analysis in order to be able to identify how like Bitcoins are moving through the network and where they're going, possibly with the intention of like finding out about people who are trying to escape taxes or some terrorist financing. And about like just another point on terrorist financing, there was again chain analysis report, and all of the money for terrorist financing that moved through Bitcoin was like $16,000 or something like this, like some ridiculous amount, but still like the governments and the people inside of governments are mentioning this, which is crazy. But perhaps one of the biggest disadvantages when compared to other platforms is the lack of programmability and automation. So it's very, very hard to create smart contracts on top of Bitcoin. It's because of the script. It's like the program language doesn't really, it's not made for this. And then we have, of course, the second generation blockchain projects like Ethereum, Thesis, Cardano, and Eternity, which are smart contracts platforms. And they're trying to improve on what Bitcoin started. And then what they are trying to reinvent in a digital form is money. Well, I mean, money is already invented kind of like by Bitcoin. But from there on, we have governance, we have like identification and commerce, and the point that we are going to focus today, finance. And for a long time, I didn't see that much happening on the finance scene. But then with the DeFi movement, I think this thing changed. So what is DeFi? Actually, DeFi is also known as open finance, and I think open finance or non-custodial finance is more appropriate because almost none of the projects currently in DeFi are actually decentralized. Most of them are quite centralized. Some of them are super centralized. Actually, one of the projects, like Synthetix, is, I would say, completely centralized, or at least it's unknown how centralized it is. It's not known who has access to the smart contract, what access, and so forth and so on. But let's go back to DeFi. So what is the idea of the DeFi movement? To recreate all of these things that you can see there. More specifically, what is like the biggest use case currently is lending and borrowing. This is the biggest thing, since lending rates are very high, much higher than the banking system currently offers. Also, there are decentralized exchanges. Of course, collateralization is related to lending and borrowing. Identity, I won't say that that many projects are like working on this. I will mention what identity actually is in decentralized finance. Composability and automation is also big because everything started from Maker, and new projects, the new DeFi projects that appeared were based on the DAI that Maker created, and everything from there exploited, more or less. But the main goal is to have this more inclusive, more efficient, more accessible, and more open and transparent finance, so that everyone in the world can actually have access to finance, even like people in developing countries, even like the 3 or 4 billion that are underbanked, so to say. And you can see here it's like a snapshot of all the projects that are in the DeFi sector or scene. I'm not sure if NEXO is here, because in some charts, you can see also NEXO. And this is actually, when we talk about DeFi, it's a bit of like what exactly is DeFi, which projects are considered DeFi, which are just like projects that do some financial stuff. I would say currently even centralized projects are considered DeFi. Which I hope in the future will change. I kind of think that the DeFi, the centralized finance word, like words or idea, is going to become a little bit like blockchain. It's going to be used for things that are not really what it was supposed to mean, and this is the case currently, I would say. And I have this a bit, less populated. Chart here, and this is taken from DeFi Bulgaria. So there is a meetup dedicated to DeFi, which happens the week on Wednesday before this Wednesday. So not the last Wednesday of the month, but the previous Wednesday of the month. So this chart or this image kind of exemplifies what is meant by composability. So because like at the very bottom, you have the settlement layer, which is the Ethereum blockchain. So most of DeFi projects, I would say 99.9% of those are built on Ethereum. And then you have asset issuance, and then all of the other types of projects. And of course, this is a non-exhaustive list. Today, I'll be focusing just on a few. And I think even those three are kind of a mouthful for a single meetup, so to say. So let's start with the top 3 DeFi projects. So before I jump in, just want to mention that in order to interact with these protocols, the usual way you do it is through MetaMask. There are other types of wallets that you can use to interact with those, but the most used one, the one that I use, is MetaMask, and it's just a browser extension that it's available for Brave and for Firefox and I think for all of the browsers. Yep.
So something interesting in that context is that there is a convergence. So MetaMask is an extension itself, but what we've seen happened quite a bit in the space is that there is a convergence of wallets creating internal dApp explorers and also some browsers integrating wallets. So for example, Brave has an integrated wallet. That's part of, it's an extension of the fact that they have their own token and there is an ecosystem around it, but also Opera has their own integrated wallet as well, which is, a relatively like second tier in terms of popularity browser.
Yeah, actually, I've tried to use Brave's wallet, but because I had MetaMask, for some reason it didn't work, and both of them kind of destroyed each other. So I couldn't use a wallet. If I had to manually stop Brave's wallet in order to use MetaMask. But yeah, MetaMask is actually your identity in DeFi, and your identity is basically the public key and the balance that you have inside of that public key. So this is your identity. There is no KYC in DeFi. You don't have to go through some lengthy process of identity verification. You just need to have MetaMask with some balance. Usually you can start with Ether only, and then you go from there. So this is identity in DeFi. This is what I like. Sorry? Yeah, no credit checks. Maybe this will change in the future when regulators get more interested in the field. But for now, it's like that. So we start with MakerDAO. And MakerDAO is the biggest by far project in the space. It has above 54 or 60% of all value in the DeFi space is actually inside of MakerDAO. So it's open source and it's also a decentralized autonomous organization. So this is a good example of one of the projects in the space which are more decentralized. So they have started with decentralization in mind from the very start. And it has two foundations behind it. So the Maker Foundation, the DAI Foundation. And the DAI Foundation is basically just managing some trademarks and code copyrights. And it's based in Denmark. And the Maker Foundation is actually the foundation that manages the Maker protocol. So yeah, it was launched in 2017. Actually, founded in 2014, so quite a while ago. Basically at the time when I was first getting into Bitcoin. But for 3 years, there was not much done in it because, as far as I understood, Ethereum was not really ready to, technologically ready to allow the creation of something like this. And it's really at the core of the DeFi movement. And I think one of the biggest reasons behind this is because it has been around for the longest. So the longer this project stays, is in the space and has proven that it can be relied on, it can be trusted, the more people trust it and the more people are willing to use it and put real value in it. And even in 2018, when the Ethereum price was falling, the price of DAI, which is actually the product of MakerDAO, it's a stable coin, the price stayed pretty stable, which was a big test for MakerDAO, and it went through it very, very well. So around the MakerDAO, there are two, as I said, two main assets. And the one is DAI, and it was Sai before that. And Sai is a single collateral DAI, which means that you are only able to use Ether as collateral, and now DAI, the actual the DAI currently existing, you can use also BAT tokens from the the Brave browser tokens for collateral as well. But I think nobody actually uses this, or it's much less used than Ethereum anyway. So now it's called actually Sai was DAI before. And now the new DAI is called DAI, and the previous one that was renamed to Sai. And you can transfer Sai to DAI easily. And then there is also the Maker token, which is only used for governance. So if you have Maker tokens, you can take decisions on changing some fundamental system variables. So, right. So what do you use Maker for? So as I said, if you have Maker tokens, you can participate in the governance of Maker. And there are two types of votes. So you can you can participate in these two types of like governance procedures. And one is the general, the more like the softer type of governance is called governance polls, which is kind of probing what the people inside Maker think about a certain issue. For example, should we increase the stability rate? And I'll be talking about the stability rate a bit later. But it's like just a way to build consensus about something that might in the future actually be implemented in the system, and how it's implemented is through executive votes. And you can kind of understand these executive votes as hard forks. So so basically, anyone can at any time, anyone who has Maker tokens can propose a vote, and all of the Maker token holders can vote on it. And how do they vote on it? By staking their Makers to the new proposal. So this is like the continuous approval voting. So basically, there is a proposal which is, let's say, the stability fee is 10%. And since most of the Maker is staked on that proposal, then the stability fee is 10%. But then a new proposal appears, and if like more than 50% of these staked Maker tokens migrate to this new proposal, then that becomes the new so to say, the new reality for the system. So let's say the new proposal is 15%. So 50% becomes the new reality for the system. So that's why it's called continuous voting. And also there could be a proposal that stays around for a while. It could stay forever and nobody votes, but at some time in the future, this proposal becomes more interesting for the makers, for the Maker holders. And then people start to migrate their tokens to it or staking amounts to it. And then that becomes the reality. Whatever it was inside becomes the reality for like the state of the Maker DAO system. Okay.
So something interesting here is that actually the voting participation is relatively low, and the reason for that is allegedly the fact that a lot of the supply is held by institutions that use third-party custodians, and most of the existing third-party custody solutions rely on cold storage, which means that those tokens cannot actively participate in the network. And that's why actually like the decisions are made by a very tiny sample of the holders, because a lot of the holders are not incentivized enough by the changes that are being made, so that they would go through the trouble of like retrieving the asset from cold storage and voting.
Actually, I read about this, and I think with the new DAI, there was a method introduced that you can actually store your tokens in cold storage, but then at the same time use them for voting. So maybe what you're saying was kind of upgraded, because I'm pretty sure that there is a way. I think there is a smart contract, or not that I think there is a smart contract in which you can put your Maker inside, and that's considered like cold storage, and it's so programmed that you can it can only be used for staking, and the only way that the Maker tokens can go out of it is to the address from which they came. So there is no way to send them to a different address. So I think this was introduced by the new DAI, the upgrade of the new DAI, so that it allows more people to kind of have their tokens in so-called cold storage and at the same time vote with those. And now you can see the price. Maybe today, maybe it went a bit lower today. I'm not sure. It's about $600. But as you can see, there's about 1 million. So in order for your vote to kind of make sense, and maybe this is related to voter apathy in general for the government systems, you actually have to have quite a few Maker tokens in order for your vote to actually count or make sense. And maybe this also stops more people from voting. But yeah, 1 million in circulation. So shouldn't there be something else here on this slide? I'm not sure. But yeah, so the DAI. So the DAI is actually the product of the maker. And this is I think one of the most interesting cryptocurrencies out there because it's a stable coin. So it's softly pegged to the US dollar, which means that a soft peg means that it's not always one-to-one, but there are slight variations over and below the price of $1 US. But throughout time, it has always like kept its price very, very close to $1. And it's collateral backed, which means that in order to create DAI is created, it's an ERC20 token, you need to put some collateral, which is Ether or BAT tokens as collateral. And so you basically lock those like the Ether that you have and lock the BAT or whichever you choose, and then you create new DAI. So I think I have, maybe this is, maybe I have to, like, I'll just jump to this slide and I'll go back to the previous one. So how does this thing work? So let's say you have $100 in Ether and you go to the CDP portal or Instadap or DeFi Saver, like all of these 3 protocols you can use to create DAI. You connect your MetaMask, of course, and you have to have Ether or BAT inside. And then you have to decide how much you want to lock. And there is a collateralization ratio, and that is 150%. So it means that if you have $100, you can only create 50 DAI. And this isn't the case that basically you are very risk prone because if the price of Ether goes down a little bit, you'll become under collateralized very, very quickly. And when this happens, a few other things happen. I'll talk about those a bit later. So if you do this, you have to monitor the price of Ether or BAT, whatever you have used, in order for your position not to get closed. So why actually create this DAI? I have given one example at the end of the MakerDAO presentation, but yeah, so as I said, it's a decentralized stablecoin. So if you have Ether, you can basically lock it without selling it. You just lock it. You can get it back at any time, and you get an additional value out of it. It's true. It's like twice less than the value of Ether that you're locking because of the 150% collateralization ratio, but it's still additional value. And with that DAI, you can actually, if you think that the price of Ether will go up, you can buy even more Ether. So if you have $100 of Ether, you create $50 of DAI, and you use these $50 to buy $50 of Ether again. So you have more Ether. But you cannot get your original $100 Ether back before you return your loan of 50 DAI. So you can use it also for payments. There are ICOs, like for example, if you have done an ICO, you have raised a shitload of Ether, and you don't want to sell that Ether, you can just lock it, get the DAI, and then use the DAI to pay your workers, or whoever is working in the company. And it's a stable value, so it's very good for payments. It doesn't fluctuate. It's $1. And yeah, the other way in which you can use DAI is not by actually locking Ether and getting DAI, but by just purchasing DAI directly from an exchange. You can go to Uniswap or Kraken or whichever exchange, use Ether to buy DAI or US dollars to buy DAI, and then you can lend it and get about, I think currently it's about 8% per year for making this DAI available to borrowers. And 8% per year is a very, very large, very high interest rate, especially when compared to what the banks are giving you, which is less than 1%, in some cases below 0. minus 5%, let's say. So if you have dollars, you can go to the exchange, have $100, $1,000, get 1,000 DAI, stake it, and then after 1 year, you get, 1,080 DAI. If of course, the exchange rate is always 8%, and that changes. So this is what I was referring to below. So there are two types of acquiring DAI. You can either create it using ETH or BAT, I missed this, or buy it from my exchange directly. So this I went through already. So how do you get your DAI back? So in order to, Ether back, sorry. So what you need to do is find 50 DAI from an exchange or sell your Ether or whatever. Then you need to also have to send them back to the Maker protocol in order to destroy them and get your Ether back. So, but before you can, so apart from these 50 DAI that you need to pay out, you also need to pay out the stability fee, and this stability fee is actually the interest rate you pay on the loan. So it's not like you are getting $100 of Ether, getting 50 DAI, and then just getting back this 50 DAI. You need to pay the stability fee, which is also a certain percentage, and the stability fee is actually also governed by Maker token holders. So it changes all the time, depending on the votes of the makers and the Maker holders, and they take these decisions based on the state of the system, whether there are like too much DAI in circulation or too few DAI in circulation. And the stability fee, it's like a term which is inside of like created by the MakerDAO project, but it's actually your borrow interest rate which you need to back. So when you're taking a loan, you also generally you don't just pay back the principal, you pay also a little fee for the fact that you have been able to borrow. So CDPs. So these CDPs, actually I kind of mixed this presentation a little bit. This was a previous slide. Maybe I need to go through this. So a CDP is this thing that you participate in order to create this DAI. So when you stake the Ether and you get the DAI, it's through a CDP, a collateralized deposition. And then, as I said, collateral either or BAT. Stability fee is the borrow interest rate, which is currently 9.5%. So it doesn't really. So in this example, like with the interest rates and the 8% interest rate, which is super high, it only makes sense for you to use this 8% interest rate if you have acquired DAI through an exchange. Because if you create the DAI by locking Ether, you have to pay this after 1 year. And if you just like create the DAI and then lend it, you get this after a year, so it'll be 1.5% behind after 1 year. So it only makes sense to buy it directly from an exchange. And then there is this new concept, DAI savings rate, which was introduced when the MakerDAO system was updated by like the moving from single collateral DAI to the multi-collateral DAI. And it's basically, it's a way for owners of DAI to lend their DAI. So it's basically like Compound, but inside of the MakerDAO project. So you can lend your DAI inside of MakerDAO and not use a different DeFi, DeFi protocol. And as I said, collateralization ratio is 150, but usually users go through to 300. Because if the price of Ether goes down too much and your CDP becomes under-collateralized, a liquidation procedure might start, and this means that your CDP will be closed automatically. And when it's closed, you have to pay a 13% liquidation penalty. And it's kind of, I mean, you lose the ether. You can keep the DAI, but you lose maybe a large percentage of the ether. So you have to be very careful with the movement of ether. So let me get back to this one. And this is what I was talking about. What if the CDP becomes under collateralized? As I said, like it gets liquidated. And there are two actors here, and a repossessor and a liquidator. So usually these are bots, which are like monitoring the system to see if there are certain CDPs which are becoming under collateralized, and then they start acting. And the first one is the repossessor. There could be one bot. Actually, both of them could be just a single bot doing both things. And the first thing that they do, they bite, which means that they take your ETH, which is in your CDP, and they move it to the liquidation pool. And then they decide that if they can sell it, for a profit. And if they decide that they can sell it for a profit, they become also liquidators. So basically what they do is they automatically pay off your debt with by returning the DAI. They take your ether and they sell it at a premium, so below market rate. So they win money in this way by liquidating your positions. And there are bots constantly looking inside of the monitoring what's happening so that they can make a profit. And then of course they are automated. You don't have to do this manually. Yeah, that's why there is this 150% over collateralization, because these 50% are used for for this procedure of liquidation, so that the bots basically can make money. And so what moves the stability fee? As I said, it's governed by the MakerDAO holders, by the Maker actually holders. And if the DAI moves below $1, this means that there is too few DAI, too much DAI actually, so that the stability fee needs to go up. So basically this means that if you have a CDP open and you have to pay 9% per year for that CDP, suddenly that 9% can turn into 25%. And then, of course, since you're a rational user, you have to you say, well, I cannot pay 25%. That's too much. I will close my CDP. So I will destroy the DAI that I have. And this actually, the opposite thing happens when the stability fee, when the actual DAI is above $1. Like this means that there is too few DAI in circulation, and in order for this to be corrected, the stability fee should go from whatever, like maybe it was 9%, it goes to 4%. So this makes it more lucrative for people to open CDPs and create more DAI, because it's just 4% that they need to pay out after 1 year. And perhaps if the price of Ether, if they think the price of Ether will go above that, it's of course, it makes sense for them to create DAI and buy more Ether with that DAI. And so this is kind of how the system is regulated. And to the stability fee, you also now you need to add what I mentioned, the savings rate. So the savings rate is kind of making you also take DAI out of the supply, because you're getting, if you have DAI, you're taking it, you're locking it in, and you're getting this rate per year. So it's also stimulating. This is another mechanism by which the price of DAI is regulated. So it keeps the $1 peg. And yeah, so you can see how the stability fee has moved. Throughout the months, it was at one time 20%. So that's quite high. And yeah, now we are about at 9%. So there's one example about like what you could do with DAI. One additional example from the ones that I just mentioned. So you know that ICOs, you usually send Ether to ICOs. So when you do this, you kind of take up the risk of two risks. One risk is the price of this token, the amazing ICO token, going down. And the other one is the Ether price going up. Because if this goes down and Ether price goes up, since you have lost the Ether, you're basically, yeah, double screwed, so to say. So what you can do by DAI is actually, if it's possible to invest DAI in an ICO, and kind of makes sense for this to be possible at some point. I haven't seen it yet, but it kind of makes sense. You have 2,000 USD. Yeah, this is, I should have removed this. There was a weird example where you have 150 USD and then you have 1,050, USD, and then you have 1,050 DAI. So I kind of changed it, but I forgot to remove this part. Don't look at this. And imagine that this 5 doesn't exist, it's just a 0. It's because I couldn't remove the 5 from here. But let's say you have 2,000 USD, and then you create 1,000 DAI out of this. And then you invest these 1,000 DAI in the amazing ICO. And the price of amazing ICO goes down, and you sell whatever your tokens you have, and you have 8,000. You get 8,000 back from this amazing ICO. So you're 250 USD like below. Because of the 5 here. So what you need to do in order to get your Ether back, you just find 2,000, you buy DAI for $250 and you unlock your Ether. And if in this situation the Ether price was going up, you could cover your losses from investing of this investment like amazing ICO. Like in this particular case. So basically you could have removed any losses that you have had by not giving your Ether to this amazing ICO. So this is one use case. Of course, it's also possible that during this time the price of Ether was also fallen down, but at least you get Ether back and not this amazing ICO, which could fall even like further down in time. So yes, this was MakerDAO. I'm not sure if maybe it was a bit, I don't know. Are there any questions? Was there anything that was kind of unclear? It's kind of hard to wrap your head around it at first, but once you like go into it, kind of play with it, it becomes easier to understand. It's just a very interesting use of ethers or of cryptocurrency. You basically have this volatile cryptocurrency that cannot be used, like Ether, for example, cannot be used for payments because it goes up and down in price. And then from it, you can use it as collateral and create this stable cryptocurrency, which you can use for payments or for whatever else, like payments for your inside your company and so forth and so on. And of course, you don't have to create the DAI yourself. You can just purchase it from some exchange. And the primary use of DAI currently, I would say, is speculation. People who think that the price of Ether will be going up in the future, they simply want more Ether. And you can get more Ether by having Ether in the case of DAI, because you can lock it, you get this like additional amount of money that you can use, and you can purchase more Ether with it. And if the price goes up, it's kind of like a margin position, more or less. But I think it has also other use cases. I think there is some kind of a nation or a country which has implemented DAI as a way of like doing payments in the government or between the government and some suppliers. And also DAI it could be very useful for countries where they don't have a stable currency, like Venezuela, for example. You can use DAI for payments there, or just like a digital representation of the US dollar, so that you can have price stability, more or less. But let's jump to the second one. And these two, the next two are shorter in terms of content than what it was like what I mentioned about DAI. So the next one is Compound.fiinance. And I've used this one. It's quite very like easy to use. I'll do a demonstration, but you have to bear with me with the demonstration, because I have to pay fees, and the Ethereum network needs to verify a transaction, so it could take some time. But I'll show you how this works in practice. So let's go through it rather fast. So it's a San Francisco-based company. This guy there is the CEO. He had two funding rounds. Got quite 30 million, more than $30 million. And as you can see, the white paper kind of happened between the funding rounds. So first they received the seed funding, then they had the white paper, and then people were super impressed by the white paper, I guess, and they invested 25 million more into the company. So it's another protocol, so like a smart contract protocol on Ethereum, and it creates money markets. And money markets are basically what it means. It's like a market for money, where you go to take money, and it's a kind of a complex definition or explanation of just somewhere that you go and lend your money or you borrow money from. And it was functional before the DAI savings rate was introduced. So yes, you can see all of the different coins here that are covered, that are supported currently by Compound. And the most interesting, the ones with the highest interest rates, of course, are DAI and USDC coin. And USDC coin is another stable coin, which is actually fully regulated, I think, in the state of New York. And it has went through a number of audits. And there is one USD dollar to support each of the USDC coins that exist in digital form. So it's a very, I would say, trustworthy project. But the tricky part about it is that if the company behind the USDC coin determines that the USDC coin is being used in some transaction that is not acceptable or doesn't follow some principles, subjective principles, they could basically remove this coin from circulation. So the coins that you have, the USDC coins that you have, at some point they can just simply disappear or become valueless if the company behind the project deems so. So it's very, very centralized, like fully centralized stable coin, unlike DAI. So yeah, let's go forward. So in the DeFi ecosystem, so there's this framework which I'm not sure anyone's using, but it's inside of a blog post and kind of liked it. So Compound and Maker are considered degree 3. So here's NEXO actually. It's CeFi. It's not really centralized finance, which is it's not a bad thing. It's a different way of looking at things. And you go further up the spectrum, and you go to Compound and Maker. And I think Maker is actually a bit further than Compound. But actually today, Compound announced. Actually, I read this news like five minutes before I got here. Compound announced that they are going to be creating their own governance token, which is kind of similar to the Maker token, and it's going to be called Comp, C-O-M-P, and that will be used for governance of the Compound system as well. But it will be introduced in the future. So hot news, you first heard it in Sofia Crypto Meetup. So yeah, you can see where Compound is. It's not very decentralized, but they are very open about the fact. And if you go to their white paper and you go to governance, you can see what actually they can do with the smart contract. That is actually the compound smart contract, like what kinds of actions they can take. So yeah, they can do a lot of things. I'm not sure if they can steal all the money and run, actually, if I look at this list. But it might be possible. And this is actually interesting. This kind of shows that you can have different things that you can have access to in a smart contract. So it doesn't, when you have a smart contract, doesn't mean that you can completely control it. You can make certain things uncontrollable and like hard-coded, and other things controllable by you. And in the case of Compound Finance, this is actually the case. They cannot control everything, but certain important things they can. So it's kind of semi-decentralized, possibly more decentralized in the future. So how do you use it? And this is an example. It's super, easy to understand. Of course, it's just acquire DAI, buy it from an exchange. Don't create it. Don't create it, because if you create it, you have to pay this stability fee. 5,000? You mean? Or which one? Yes. Yeah, so this is 5,000, sorry. Because I was kind of trying to figure out what is the exchange rate between DAI and CDAI, and then I figured it out, but I forgot to change it here. So this is like 5,000. But yeah, you just buy the DAI from somewhere, go to Compound, like put it in the MetaMask, go to the Compound, put it there inside, you get in return CDAI, and basically, you'll be receiving interest rate on that. And how the interest rate works, it's very interesting, and it's related to CDAI. So here's an example, kind of messed up example, I guess. I forgot to kind of change this, but the idea is that this CDAI has two functions. So basically, when you deposit your DAI in Compound, you get CDAI back. So it's kind of like a receipt that you have actually done something on the Compound protocol, and you get some tokens back. But also through these tokens, you receive the interest rate, because in time, let's say in 1 year, that CDAI will be worth more DAI. So the exchange rate between DAI and CDAI evolves through time. And I've tried to kind of explain how this works here in this slide. I'm not sure if you, it will be very understandable, but everything comes from this formula. And this formula is actually hard-coded. They cannot change it. Like the Compound guys cannot change this formula. It's always it's always there. And it's the underlying balance is the total borrow balance minus reserves divided by the C token supply. And it's like these things that I've put here, and I had the good intention to kind of show you where they're taken from. But if you go to Etherscan, you write Compound, and you can open like the Compound, the primary Compound smart contract, and there is a tab where it said read contract. And if you go inside of the contract, you can find these things, and you see these numbers in there. So it's completely open and transparent. And at any time you can go and you can actually do the calculation itself. Actually, you don't have to do it, because the exchange rate is also available in the contract. So this is what I also like. This is kind of why it's called open finance, because you have the formula, you can see it inside of the smart contract where it's written in code. And then you have all of the different elements of this formula also available in the contract, and you can make the calculation. I actually did this just to make sure that it's correct, and it is. And so this is the exchange rate between CDAI and DAI. And this goes up in time. So in time, it becomes like 2.026, and then 2.027, and so forth and so on and so forth and so on. And then in 1 year, the C DAI that you got will be worth more DAI when you exchange it back. So this C DAI is very interesting concept. And as I said, this is open finance. It's what I like. Do you know how your bank calculates the interest rate? I mean, it's not that clear. I mean, different banks do it in different ways. And the other interesting thing that is introduced by Compound, and it's called a liquidity pool. And this is something that other projects in the sphere have also incorporated. So when you deposit the DAI, like all the different users that exist, they deposit the DAI in a single smart contract. And that smart contract has access or manages a very large amount of DAI. And that smart contract becomes actually the lender to all borrowers. So there is no need to have like an order book, which is usually off-chain, and you have someone who wants to borrow 1,000 DAI, then there should be someone on the other side who wants to lend 1,000 DAI, and then you can match them. You don't have to do this because there is just one big pool of DAI, and no matter how much you want, if it's below the value of the pool, you can borrow it from the pool directly. So no matter what kind of like amount of DAI you want to borrow, you just directly borrow it from the smart contract, which manages the DAI, which is kind of, I mean, quite I would say, very smart thing to do because it has been tested that order books don't work since like borrowers and lenders have different preferences of how much they want to lend and borrow, and to match them is very, very hard. So yeah, this is pretty cool. So this means that looking at this, you can borrow, anyone can borrow up to this amount. So if you want to borrow, yeah. Actually, you cannot borrow 33.43 million, because if you borrow the whole amount which is in the pool, and I want to take my DAI back from Compound by sending C DAI, I will not be able to do it because there is no DAI in the pool because everything is borrowed. So it's actually should be always below this amount, maybe a little bit more amount, just a little bit lower, but it cannot be this amount. Or it can be, but everybody will be stuck. Like you won't be able to get your DAI back with the C DAI. And the other, just finally, one other good thing about this is that you can lend and then get back your DAI in the matter of just 2 transactions. You can at any time lend your DAI or whatever other currency and get it back whenever you want. So this is also pretty cool. You don't have to call your broker or go to the bank or do whatever. You just basically close your position, get your DAI back at any time. So yep, Ivan.
Yeah, I just wanted to mention that basically, like the idea is that it self-regulates. So as you start eating into the 33 million, the interest rate would grow. So you would borrow at progressively higher rate, and then that should ideally incentivize more lenders to step in because they'll be earning more.
Yeah. It's also in Compound. It's also there are 2 rates: the lending rate and the borrow rate, and through those rates they can control the supply of DAI in this particular pool. So just like Maker, so it's pretty cool. And then finally we have Synthetix, and that is also quite like number 3 DeFi project. Very interesting project, I would say. What they have tried to do initially is actually do something like what MakerDAO were doing. They wanted to create a stable currency. But once Maker did it with the DAI, they were unsure what to do, and they kind of pivoted into something similar, but not quite. So Yeah, you can see they've raised about 30 million. I found out by Ivan that they have, after this, they have again raised, but I think from institutional investors after this ICO. The light paper was out in December, so it's like just 4 months ago, very, very new. And yeah, this is the Kane Warwick. I don't know. Maybe.
They couldn't have raised that much money without
Yeah, I was kind of surprised to see it, but like the white paper said December 2019, and there was not like a revision or something like, or version 2 or whatever. So maybe there was it was out before that, or it was updated to something. I'm not sure. Maybe the original white paper was about creating a stable coin, and they had to change it. So again, it's a protocol. Again, a smart contract implemented protocol on Ethereum, and all of the assets are collateralized by SNX. So just like Maker, where you collateralize with Ether, here you collateralize with SNX. So you're doing the exact same thing. You're creating a stable coin, which is called SUSD, not DAI. But in order to create that coin, you need SNX. So two main innovations in my opinion here, the infinite liquidity. And so basically no matter how much, like what position you want to take, there will be always, it will be always possible to take this position. Up to actually the amount of SUSD that is in the system. But I will go back to this a bit further, a bit later. Since infinite liquidity is kind of misleading, it's always limited by something. And the bad thing about this project is like one of the least transparent ones. And I'll show you a chart at the end. Why is this? Like nobody knows who controls a smart contract, what elements of the smart contract could be controlled, when are they being like controlled, like what is being changed and when, and so forth and so on. So three main resources you can access when you go to the SNX, to the Synthetix website. The minter, where you go to stake the SNX and get the SUSD and claim rewards. The exchange, where you can do exchanges between SUSD and all these other assets which are currently available. And the dashboard, which is just information. So the first, so these are all the different assets, cryptocurrencies, let's call them, that you can actually manage. And so you can notice here that you have gold, and you have two types of indexes. So this is an index of, I'm not sure like what is the distribution ratio, but this is like an index composed of the prices of the tokens of different DeFi projects. So if you buy this, you're basically betting that all the DeFi projects in the space will be going up in price, let's say. And for me personally, like these are kind of pointless, but because it makes more sense to just buy the actual LTC or the actual Ripple from an exchange or like a decentralized exchange, and I'll tell you why. But before that, like these IBTC that you see here, the I before the symbol means that this is inverse. So if you buy this, it's basically shorting Ether. So if the price of Ether goes down, the price of this will be going up. So it's an easy way to kind of short assets. If you go to SNX with your SUSD, you can buy this. You're basically shorting Ether. And you have fiat currencies as well, which is, again, like pointless. This is interesting, as I said, because you're getting exposure to gold. So you don't have to buy physical gold. You get exposure through this. So it's kind of like if you know what was the code? Not CDP, but CMD, CFD, like CFD. So these are all oracles. So they're basically getting the information from an oracle about the price of an asset. You're not buying the actual asset, you're just buying a position of that asset. And what they're planning to do, and I think this is the most interesting, is to introduce like Apple stocks or Tesla stocks or things that you don't usually have in the crypto space. And I think this makes most sense in the case of Synthetix, because with your crypto, you can get exposure to Tesla, let's say, through this protocol. And this is interesting. For now, it's kind of boring. So the main thing that you do in Synthetix is staking, of course, SNX to get USD, and then with that USD to buy one of these if you want. You don't have to actually use the USD, you can just keep it. And if you are above the collateralization ratio, which in this case is not 150 like in DAI, but it's 750. And the reason for this is because, of course, the SNX is a much newer token. It's much more volatile. So they have decided that 750 collateralization ratio makes more sense. So if you have 750 SNX, you can get 100 SUSD. So, and if the collateralization ratio is kept, you are being rewarded by the system because there are new SNX is being created, so like inflation of SNX tokens, and there's a very generous inflation actually. It was started at 90% or something like this, and now currently it's I think about 50%. So basically, if you're staking SNX, you get more SNX in time. And the SNX that you get is locked for 1 year. So you can see it, that it's in your wallet, you can claim it, but you cannot move it, do anything with it for 1 year. I mean, only the rewards. I mean, the SNX that you have staked, you can at any time you can get it back. If you pay back the SUSD, just like in the case of DAI, you pay back the DAI, and you get the SNX unlocked. And yeah, Ivan? Yeah, you also need to pay that.
Yeah, it's actually a bit, so the inflation is massive, and because of that, the staking yield is a bit misleading because I think at the moment the staking yield is 56%, which is the gross, but the effective staking yield is about 10% because such a high percentage of the total existing circulation is locked in staking that basically like about 40% of your yield is being diluted with new supply coming in.
Yeah, it's true. Yeah, generally being paid in like the currency of the system for staking, for holding the currency of the system is kind of like a trick that is quite used actually in traditional finance as well. And it really means that you are getting more of something, but there is more of that something anyway. So basically you're not getting that much because the price of that something is going down because the inflation is so high. And the price of an individual token is going down because of that inflation. Or is pushed down. Like perhaps if there are people who believe that SNX is super cool project, they'll be buying, there'll be bulls, and the price will go up more than the inflation. So what you do, you acquire SNX from Uniswap, let's say, you go to the minter, like in this case, you have 750 SNX, and then you get only 100 SUSD. And then from there you can go to the exchange and you can exchange the SUSD for any of the assets. So a couple of specifics here, and then, like the biggest specific is that once you have opened a position, so you have not acquired the SNX from or the SUSD actually. The SUSD, you have not acquired it from an exchange because you actually can't. I think only Uniswap supports it and there's not much liquidity. But the moment you stake your SNX for SUSD, you get exposed to the total debt that is in the system. And this is a bit tricky to kind of wrap your head around. And that's why there is an example that I've taken from the white paper. And this is very interesting. So we assume here that the whole system, there is just one pair, which is SUSD and SBTC. None of the other pairs exist. And there are just two users using the system here. So it's a super oversimplification of the current system. But you have these two users having 50,000 in SUSD. And only one of the users at one point, like the step 3, actually step 2, they decide to turn their SUSD into SBTC. So they basically buy BTC with the SUSD. And then the price of BTC goes up 50%. So one of them now has 75,000 worth of SUSD basically, of Bitcoin, but this is the price in USD. And when we go down to the final step, it's the current situation. So you have one of the guys have 75, the other one has 50. So, but the debt in the system has to be distributed between the two of them because it went up with 25,000. It's being distributed between the two of them. So the net profit of the person who actually won 25,000 is 12.5. And this is a bit tricky, like a tricky concept to understand at first. So this guy loses 12.5, and this guy wins the $12,500. And this means basically that if you have SUSD, you get exposed to this what is it called? The total debt that is in the system. And the total debt in the current system is composed of all the different markets that exist. So all of these things that I showed you, the different pairs, there is a debt based on the positions of users there. And there is one big debt that everyone who has SUSD is exposed to. And that's why it doesn't make sense to buy SUSD, to have SUSD and then buy SBTC. Because your profit, which is would have been $25,000 in the real world if you have bought Bitcoin, is just like reduced here by half, basically. So it's a bit of a tricky concept, I would say. You have to, if you're interested, you can go and read the white paper. It's very well explained there. But it kind of shows how the system works. And this actually, one important point is that when you exchange SUSD for SBTC, you're not exchanging something for something. You're burning the SUSD and you're minting SBTC. So you're creating SBTC position in the system and you're removing SUSD from the system. And that's how this concept of infinite liquidity is possible, but it's always dependent on how much SUSD there is. You can actually also turn SBTC to any of the other assets in the same way. You just burn the SBTC. You don't do it. It's done automatically. This gets burned, and the other asset gets minted. So that's how it kind of works. At first, when I saw this, it was I had to kind of go a couple of times through it to understand it. But this relates to the idea of pools. So you have one single big debt pool that exists in Synthetix, and based on that pool, anyone can have a position there and use these assets. So, as I said, like the cons, even if your asset performs well, the system-wide debt might nullify your gains. So even if you don't do anything, and depending on how everyone else's positions are performing, you might be at a loss or at a gain in the Synthetix system. So it's kind of weird situation. You're taking a risk of owning SUSD or staking SNX. So this might lead that if you have minted 100, let's say, SUSD, but in the end, since the debt in the system increased, you might have to give back more SUSD, which is different from DAI, where kind of different, where you need to pay the original, like the DAI that you have taken out plus interest. So here the interest is, and again in SUSD, but it kind of depends not on a stability fee, in which like in DAI, you know how much you have to pay, but kind of on the performance of the different positions of users inside of the Synthetix system. And as I said, that this is the kind of pro, which is not super, as Ivan mentioned, it's not big of a pro, because you basically, you receive the system, like the system's inflation, but the inflation itself reduces the value of the tokens, basically. And you also get transaction fees. So these burning and minting generate transaction fees. They go to a little pool, and then they also get distributed to everyone who is staking SNX. And yeah, this is what I already kind of mentioned. And unlimited liquidity, I also mentioned this. And final slide, the advantages of DeFi and the disadvantages of DeFi. I generally advise you to really go into, if you're interested in one of these three projects, it doesn't take just one presentation to get it. You have to like watch a couple of videos or read a couple of articles about it, just really wrap your head around it. Maybe you have to do it a couple of times, actually. For me, in my case, it was like that. But finally, the DeFi risks. So the advantages, you have these high deposit interest rates. And actually, these high deposit interest rates, it has been found that they actually depend on the price of Ether. So if the Ether is going up in price, the interest rates, especially like in the DAI system, like in the MakerDAO system, but from there to all other systems, also go up. So if everyone's bullish on Ether, the interest rates are also going up, because people are willing to pay high stability fees or interest rates on their borrowed amounts, because they know that Ether is going to go up, or they think that it's going to go up, and this gain from the Ether exposure will be much higher than the borrow interest rate they have to pay back in time. And also, you don't have to keep it for 1 year. You can just take it like now. Ether goes up, you make a profit, and then you close your CDP after 1 week or 1 day. You don't have to wait 1 year for for the whole amount to be. So these 8% would be just accrued for these 5 days that your position is opened. So if the Ether goes up, interest rates should also go up. So now, since it's going down, maybe the interest rates will also go down a little bit. We'll see. It's a more transparent and more open financial system. It depends on the project, of course. It's much faster type of service. You can just open it and like open your browser, have the coins in MetaMask, and then use it. No KYC and AML, and as I mentioned, you don't have to identify yourself in front of, like, for any of these DeFi projects, non-custodial. And this non-custodial, actually, I'm mentioning it at the very end, but I also mentioned at the beginning, it's also, apart from decentralized finance and open finance, it's called also non-custodial finance, because it's not really people that hold your collateral. It's just smart contracts that hold it. But if people have access to those smart contracts, I mean, it can be claimed as actually, again, people that hold it. So that's very interesting to see what the regulators will say on this. It's definitely the most dynamic subsphere of blockchain currently. The projects there are very active, and composability is related to the fact that these are smart contracts, open source, anyone can interact with them, even other smart contracts that new projects create. So you have this protocol connected to other protocol, which is connected to a different protocol. So all of them, depending on the project, they're interconnected, which is on one side very good. On the other side, if you have problem in DAI, for example, if something happens to DAI, the whole DeFi sector could be annihilated. So the biggest systemic risk, I would say, is really someone attacking DAI, or there is some kind of a code issue in the smart contract of DAI, the smart contracts of DAI, and from there on it will echo through the whole DeFi space. And as in traditional markets, there are volatility risks. It depends on how what positions you take inside of DeFi, if you invest your DAI in some other asset. It's very new technology. And the other big single point of failure is oracles. So getting information about the price of different assets. So this is a major issue for all of the protocols. Some of them use just a single point of information. Others use different points, and then they do an average. It's a big issue. If you attack an oracle, the whole system might collapse, because you might get a situation where the price for example, the price of Ether is reported as twice as low as the actual price, and there'll be immediately some people who buy this Ether at a discount from that system, and do arbitrage basically, and basically killing that system if they buy all of the Ether out of it. So some of the largest bug bounties in the industry. Everything is smart contracts, everything is code. There are a lot of smart people who are creating these smart contracts, but also a lot of smart people are trying to find a bug in those. And a few days ago, like Ivan mentioned, we had a couple of 2 hacks that resulted in losses of about 1 million in a DeFi project. And regulatory scrutiny, no regulator has actually yet stepped in to take a position on DeFi, or maybe it is. So I haven't heard it, but this is also a big problem. Although it's a bit tricky, because what will happen, because these are all smart contracts that exist on Ethereum, and if you destroy this admin key, if you just lose it, let's say, or something happens to it, the smart contract will continue to operate there, and nobody will be able to actually stop it. No regulator or no one will be able to affect its. If it continues to provide utility to the user, to the users, if it continues to function properly, there is no reason why it should stop. If the project that was originally behind it goes away. And actually, this is an idea of MakerDAO. For example, they want at some point first for the project to be completely governed by the community, and at some point, to be on its own, to be independent of the MakerDAO foundations, the 2 foundations. And the admin keys. So this is the big issue, and this is the slide of some of the most important projects in the space, and what is their current stance on admin keys and how they actually function. So as you can see, Maker is quite good because it's actually decentralized governance for using these keys. So I would say it's the most decentralized project in the space. Synthetix, though, is unknown, none, unverifiable, and so forth and so on. Different projects have different approaches to how they manage these keys. This is something very interesting to monitor and to ask questions about when a new project in the DeFi space appears. What exactly, how are they managing these admin keys? And these admin keys are actually one of the reasons why people joke about this DeFi being decentralized, because it's not really decentralized. For example, in this case, it's decentralized to 3 people, in a way. So, this is a very important Point. Huh? Yes, most probably, or just one guy who owns all of the keys. It's also possible. So yeah, I mean that's it. As I said, these three projects, each one of them could have just like a meetup dedicated to the whole meetup dedicated to them. Just one of those. I've tried to kind of put it in like all of three in just this little space of time. And that's it. So if you have any questions, ask me, or if you want, I can show you how it works. Like I can show you Compound, I can show you SNX. I have a little demo wallet that I have prepared. If you're willing to, I mean, if this is interesting for you, just let me. I mean, yeah, you want me to show you? Okay, so let's start with Compound because it's very easy. And as I said, the primary problem here will be how fast the Ethereum network actually goes through the different transactions that I need. So let's do it. Let me just put this here, and I'll put my laptop in. Yeah, let's make some money. Okay. Okay. All right. So. All right. Perfect. So, you see my MetaMask here. I have the already put some Ether and some SNX and some DAI inside, so that I can do this demo. So what you need to do to use decentralized finance, the finance of the future, like in this case Compound, just go to the Compound.fiinance website and go to the app. And the app, sees my wallet immediately. Actually, maybe you have seen it before, I'm not sure. Usually there is like a little pop-up and then you just need to verify it and that's it. But in this case, it immediately saw my wallet. Let me see if it's the, oh, no. Let me see if it's the correct wallet. Yeah, okay. So, once we are here, we select DAI, because I have DAI. And in order to enable DAI, you have to have this little transaction. Here you see the pop-up, there is a small transaction fee, and now we have to wait. But while we're waiting, I can show you what's happening here, because the same thing is happening inside of MetaMask, and when you open it, you can speed it up, and you can do a couple of other things, and you can view it also on Etherscan. When you go there, you can see that it should take about 45 seconds for this transaction to get verified, but it's always kind of tricky. But what we see here, so the current supply APY is 8%. So after 1 year, you have 8% more DAI than before. So now you see it's done, and you can see the transaction here is a success, and the same thing is inside of my Ether wallet. So apart from DAI, you of course need to have Ether for the gas that you're paying for the transactions. So the max that I can supply is 5.5, since that's the amount that I have, the amount of DAI that I have inside. But I'll just do 5. I don't know. Just it's a round number, and you do a supply. You get the pop-up again, done, and then a new transaction is being executed. So this one might take a little bit longer, but once this happens, what you have is now it's done. It's actually done, and the transaction here should be also, see, it's confirmed. And then you see here in this maybe I can, that I have for my 5 DAI, I have received 246 C DAI. And usually these are not immediately visible inside of MetaMask for some MetaMask reason, but you can go to add token and you put like CDAI, and now it shows 0, but it's just a MetaMask issue. You can go to the address which we used, which is this address, and then here you paste it in Etherscan, and it should be like the CDAI should be available, and you see it here, these CDAI 246, which is more or less $5, and that's it. I mean, that's everything that you need to do in order to use decentralized finance. Now you have five DAI, which are earning 8% per year, and at any time you can withdraw the DAI, and you say 5 DAI, you press withdraw, and it's just another transaction, and then you get the five DAI back, and the CDAI, of course, is also sent back, and it's destroyed. And yeah, and you can in time you can see there was this some place that you can see how much you are earning, but they have updated this, and possibly it's not available. No, I think this is it, and you see the supply balances goes a little bit up, but I'm not sure how frequently it updates. But this is it. It's not like going to the bank. It's just buying, as I said, just go to Kraken, have $100 or whatever, buy the DAI, put it here, and you have 8%. And this 8%, of course, it's moving, and you can see here it was 8.8, then it was 7 point something, now it's 8. And yeah, this is basically like depositing your money in a bank, but it just takes much shorter time. If you have, of course, the DAI. So the biggest issue is how to get the DAI, I would say, because in Bulgaria it's hard to send, to deposit money in centralized exchanges. But if you have Ether, for example, or any other crypto, you can exchange it for DAI. But the best thing I would say is going from something stable, which is SUSD, or not SUSD, it's just USD or Euro, and then buying with that stable currency, you're buying the stable currency DAI, and they're putting it inside of this for the 8%. And then we can go to Synthetix to show you just quickly how this thing works. Just basically the minter. This is it, and yes, so this is the exchange. This is how the exchange looks. But so you go to the minter here, and I'll use the same wallet. So it's kind of the same thing. Yeah, this is the pop-up that I was expecting in Compound. This is not a transaction. This is just like a sign. Like signing of some transaction. It's not an actual transaction. You don't have to wait for this. So it sees that I have 10 SNX here, and I can stake it. So in order to stake it, you have to mint. You go to the minter, and you see the max. So in this case, as you can see here, so this will be your collateralization ratio. But if you do this, your position will be very quickly closed. So one important thing that I forgot to mention in the case of Synthetix is that unlike in the case of DAI, when you go below the collateralization ratio of 150% in DAI, and here is 750%, you don't get liquidated. So it's here in Synthetix, it's okay to be under. So you can go to 600, you can go to 200, whatever, doesn't matter, you won't get liquidated. But you won't be able to get this, the inflation and the rewards from the system. So you will not be eligible for rewards. So this is a mechanism these rewards, this inflation from the system, this new SNX that gets created and distributed to everyone who's staking is an incentive to always be above the collateralization ratio of 750. But it's not a big deal if you're under it. You won't get liquidated. So in this case, I will just do the max. But generally, it would be better if it's like 0.5. And you can see the collateralization ratio there changes. So in order to be sure that you're getting the rewards, it's good for you to actually have a high C ratio. The higher, the better.
You can also stabilize the collateralization.
How? Yeah.
If you go, you can say like you go back, now you can press for stabilize the collateralization.
I think there is some other protocol in the case of DAI, which if you mint through them, you can tell them to pay attention to your collateralization ratio in DAI. And if it kind of goes close to for your position CDP to be liquidated for more ETH to be staked. This is again another protocol that does this. It's not done through the Maker system, but I'm not sure in this case how it works. I guess this is what you're referring to, some kind of a automatic mechanism that keeps your C ratio like in a perfect way, so to say. So what you do is just mint now, and it's again a transaction. You confirm it, and yeah, you have to wait for the transaction to kind of execute. Should be quite fast. But once it's done. I think it's done. And wait, maybe it's not done. No, not yet. And this is it. Basically, now you have, once this transaction goes through, you'll be able to, you have SUSD, and that SUSD will become available inside of this MetaMask as well. And from there, once you have you don't have to wait for this, I think. You can just go to, I suppose it's exchange. I'm not sure, maybe it's exchange. No, it's not exchange. Let's go back to this and go to the exchange. And again, you connect the wallet, the MetaMask, and now it's done. It's connected, and I don't have any SBTC. No, SUSD above here, because the transaction hasn't gone through yet. But once I do, of course, you can go to each of these pairs. So it's a decentralized exchange, and you can get exposure to gold. And what I'm seeing here is like gold is kind of going up a little bit today. Yeah, you can from SNX you can go to gold, and this is pretty cool because it's super easy. It takes a very short time to use this protocol. As you can see, just a matter of a couple of transactions being verified, and you get exposure to these assets. So that's why I'm saying that once we have Tesla or some of the more interesting stocks inside of Synthetix, I think this will make more sense for the average crypto user. And yeah, this is it. It's super easy to use, and I hope it doesn't get killed by a DAO-like hack which we had a couple of years ago, which kind of stopped or killed most of the work that is being done on decentralized autonomous organizations. And since the MakerDAO, which is at the core of DeFi, is a decentralized autonomous organization, I hope it doesn't experience such a hack, because it will kind of also kill this great idea of, I would say, decentralized finance. So yeah, guys, this is it. If you have any questions, I can try to answer them together with Ivan. Yeah.
What about flash loans?
Yeah. So flash loans, it's a bit tricky. I haven't really like went into Flash like to see how this works in detail, but I can just mention it. So a Flash loan is kind of like say Compound, where you can loan some of the assets available in the Compound system, but you don't have to provide any collateral. So you can take a loan of 1,000, let's say 1,000 Ether, but you don't have to supply any collateral for that. Or 1,000 DAI, let's say, you don't have to supply what is like 1,500 Ether as collateral. You don't have to do it. But what you have to do is you have to give the loan back in the same block that you have taken the debt. So you can take the debt, and in the time, like in the case of Ethereum, it's like about 15 seconds until the block is minted or verified. You can do whatever you want with that amount of money, but at the end you need to give it back in the same block. So what some people are doing, and this is how these hacks of Flash loans happened, they took a large amount of Ether without collateral, of course. They some of it they opened a long position with, with the other they opened a short position, and basically they manipulated the price through an oracle. They used a decentralized exchange where there is very low liquidity, and with 500 Ether you can basically change the price. And once you change the price, with the rest of the money, they opened the position in which they actually earned. So they manipulated the price and earned from the moving of the price on that particular exchange. I think what they did is basically, I think they bought the Ether for much less than it was supposed to cost, or something like this. If you know more, and just correct me.
Basically, the idea is that you crank up the gas price and you sequence the actions that they would be prioritized, and it will appear in the same block, and you basically go around the places and do different shenanigans everywhere. And
Yeah.
Get back to the first point, but for example, like bigger systems like Maker, to protect from that, they have like a lag in the price feed. So an oracle wouldn't take the price within one block, but it would average over several past blocks. And in this way, you would avoid this type of manipulation. So basically, a big issue was that BZX were using
Fulcrum, I think.
It's the same project.
Yeah.
They were using an oracle that didn't have that protection mechanism inside. And
so all of these steps, they also relate to the fact of composability. So they are taking the Ether from one protocol, they're borrowing, they are shorting it in another protocol, longing it on another, and all of these steps, all the different steps are done in one single block time. So it's like 13 seconds. So these guys paid about $8 in gas fees and earned a million worth of Ether by basically manipulating the system, or this oracle. Like one of the hacks was oracle related, the other one, the first one, was not oracle related, but I don't remember what was the issue for the first one. But it's perhaps the Flash loans really open up a lot of possibilities for hackers. And most of the DeFi protocols, or at least BZX, was not ready for this. They've had issues with the audits of their protocols. I guess they didn't correct the issues in time. Very important thing to mention, all of these DeFi protocols, it's important to when you're looking at them to see which companies are doing security audits on them. It's one security audit usually is not enough. And also it's not enough to do it just once in the beginning. especially if you are changing the system or modifying the smart contract after that. You have to do another audit because yeah, any modification of the smart contract could open some open some attack vectors. So it's important and most of them go through very serious audits. And for most of them, serious faults have been found before they launch, thanks to these audits. So hopefully, yeah, this becomes a very widespread practice, and some of that ICO money or investor money goes into really doing audits on your code. Yeah, that's it. So I'm not sure about BZX. They decided to do some like they tried to underplay what has happened, but I think users. Sorry, what?
They just reverted the transactions.
No, of course it's not possible to revert any transactions.
They were exploring the possibility, but
Yeah, I mean.
That would mean hard.
Yes, exactly. So reverting transactions would mean that you need to do a hard fork of the Ethereum protocol, which was not done in some very serious hacks in the past. No.
It was done, but not because of a hack.
It's something else was done. It was the DAO hack. The DAO hack actually, it was, but it was not a whole hard fork of the system. It was a hard fork, but it was just like a small part of the system was changed. Just one single transaction or a few transactions were reverted, and that was because that was possible because the money that was extracted from the DAO smart contract were locked for a period of 1 week. So in this 1 week, the Ethereum community was able to think of how to address the issue, and they have decided to revert this one transaction and not the state of the whole system. But in the case of this hack, when the attacker just gets the ether, they can transfer them all the time to different accounts, so it creates a big mess. So in this case, it's it's much more difficult to do. So yeah, I don't think it's any chance for 1 million of stolen funds to revert a whole blockchain which is worth, I think, billions. I'm not sure how much, but most probably billions. Any other questions?
Can we make money out of this?
Yes, now you can make money with two things that I mentioned. You can make it in the less risky way by just depositing your DAI or USDC or whatever and getting a good interest rate, which is much higher than anything else, or you can use it for speculation. You just, as I said, use your ether to buy more ether, and this is it. I mean, maybe there are other ways. Yeah, if you're a developer, find a way to hack it, and then you get $1 million for 13 seconds and at a cost of $8. So it's a pretty good deal, I would say.
That's pretty much like Bulgarian government.
I don't know. Any other questions? I mean, there are many other protocols out there. I am beginning to go into those in time, but this is the most interesting ones for now. And I would suggest for you to start, if you're going into DeFi, to start with those, and then start digging deeper. And I would say the most deepest thing that you can do is flash loans. How they work exactly. It's maybe it's not that complex. I haven't looked into it, but this is the most technologically advanced, I would say, thing in DeFi currently. So this is it. One.
How is it possible to sustain this situation for a long time that in the crypto space there are 8% interest rate and in the physical space the interest rate is about 0?
Yeah. So as I mentioned, the interest rate currently in the whole DeFi, and actually if you go to DeFi Pulse, you can see all the different. Was it? No. It was DeFi rates. Sorry, DeFi rates. So you see here when you go to, was it this?
also in, for example, Compound.fiinance there is interest. You can see the DeFi and CeFi. So
Wow.
also you can see all the rates.
Yeah, I mean there are a couple of places where you can go and you can see different rates, and most of these, especially in the projects which are mainly dependent on DAI. And it's also, there is this one person, like an analyst in the space who has done some research, and he has concluded that the interest rates in the whole space are governed by primarily by the interest rates of DAI. So as I said, if Ethereum's price is going up, you can even see rates of more than 8%. They can go up to, I mean, basically to 20% even. You can get 20% yearly interest rate on your deposit. But this is in bullish market. So it's kind of dependent on how much the borrowers are willing to pay in order to get a loan in that particular currency. So if they're willing to pay 20% for that loan, you can also get like 15% for just lending to them, because the borrow rate is always higher than the lending.
But yeah, I think your question was more about the disconnect between like the rates in the real world and the rates in crypto. So us being a bridge between the real world and crypto, like there are a few frictions that justify the discrepancy remaining relatively sustained over a period of time. So in terms of small like retail users looking to earn return on their capital, obviously there is, I mean, what Vlad was showing looks quite simple for someone who uses crypto on a daily basis, but like for the vast majority of the population, like MetaMask, putting money in in a widget on your browser and then like earning interest through that is not a very user-friendly process. Yeah. So like that's one of the reasons when it comes to retail users. So first is friction in terms of user experience. Second one is it's not that common, like not that many people know the space and trust it. So there is like the risk premium, as in like we see it as a risk-free rate, but for someone who is not familiar with the space, it's like magic internet money, like when is it gonna go to zero? And then on the side of professional asset allocators, it's again the risk, right? For them, it's a bucket where they would expect a much higher yield than money in the bank. So like even if a bank comes in and they are like, oh yeah, we want to earn within that crypto space stuff, they would demand like very high rates that would be in line with what we are seeing inside the industry.
Because of the risk.
Yeah.
So basically, he's saying that the risk is higher, and of course it's higher due to the fact that you're not depositing in the bank. I mean, yeah, banks generally are considered, like deposits in banks are considered, for example, in the European Union, up to 100,000 euro is considered safe, but everything above that, if there is a bank run, you lose it. But generally, for deposits below that, it's fine. It's secured. But in the case of decentralized finance, of course, everything is managed by smart contracts, and these smart contracts have bugs. So there is this risk that exists. But I think the risk, I mean, my personal opinion, is not that much of a, like, it's not represented by the rates, really. It's just a matter of if someone is willing to pay, like for example, in this case, someone is willing to pay 23% to borrow DAI. So they're willing to get back 23.7% more than they have borrowed. And actually, if there are people who are willing to do this, then we have these numbers as well, because this is also like basically they are paying for this to be possible. So for me, this is how the actual rates are calculated, and of course, as I mentioned, the stability rate of DAI. You should be watching this in order to kind of look where the what's happening in DeFi and how are the other interest rates doing. And you see there are certain protocols like Aave, for example, here is giving you a better rate, but for 30 days it's not that much. And Aave it's a newer protocol, so newer smart contracts might be higher risk. So maybe that's what they're trying to attract users with this higher interest rate. And I think on USD it was even higher, even for the 30 days period it's higher. But it's still, it's riskier. I mean, at least I wouldn't put much money in Aave for now. Maybe in 6 months, possibly. So also the stability rate, there was this point that the stability rate, the DAI stability rate, so basically the interest rate borrowers are paying, could be accepted as a prediction market. So you can look at the rate to determine if the price of Ether is expected to go up in the future. Because if it's low, then people don't think that the price of Ether will be going up. If it's high,